Here is one of the simplest wealth-building ideas in investing, and most people still underestimate it. Imagine two Canadians. Both invest $10,000. Both buy the exact same dividend stock. Both hold it for 30 years. Neither investor contributes another dollar. Investor A collects the dividends and spends them. Investor B reinvests every dividend automatically through something called DRIP. Same company, same starting investment, same dividend payments. But after decades, Investor B can end up dramatically ahead. Not because they picked a better stock, not because they timed the market, and not because they contributed more money. They simply allowed the dividends to buy more shares. And then those new shares started paying dividends too. That is why dividend investors can get rich twice. First, they get paid through cash dividends. Second, those dividends can buy more ownership, and that ownership can create even more future income. This is the dividend snowball. It starts small. It looks boring. And for the first few years, it almost feels like nothing is happening. But over time, the portfolio starts doing something most people never experience. It begins helping build itself. So in this video, we are going to break down exactly what a dividend is, how DRIP works, why reinvestment changes the math, why the TFSA makes this especially powerful for Canadians, and the biggest mistake beginner dividend investors make when they chase yield instead of quality. Let's start with the foundation. A dividend is a payment a company makes to its shareholders. But the better way to understand it is this. A dividend is your share of a business's profits. Imagine you own a small pizza restaurant. At the end of the year, the restaurant brings in revenue. Then it pays employees, rent, ingredients, utilities, insurance, and taxes. After all expenses, the business has $100,000 in profit. As the owner, you have a decision to make. You could keep that money inside the business. You could open another location. You could pay down debt. You could upgrade equipment. Or you could take part of the profit out and pay it to the owners. That payment is basically a dividend. Public companies work the same way. When a profitable company generates cash, management decides how to use it. They can reinvest into growth. They can buy back shares. They can reduce debt. Or they can return cash directly to shareholders through dividends. That is why dividend investing is really ownership investing. If a company pays $1 per share in annual dividends and you own 100 shares, you receive $100 per year. If you own 1,000 shares, you receive $1,000 per year. Same company. Same dividend, different ownership amount. That is the entire concept. More shares equals more ownership. More ownership equals more dividend income. And this is why banks, utilities, pipelines, telecom companies, and REITs are often popular with dividend investors. They are mature businesses with steady cash flow. They may not grow as explosively as younger companies, but they often return part of their profits to shareholders consistently. The key point is this: dividends are not free money. They are not a bonus. They are not a trick. They are business profits being distributed to business owners. And once you understand that, the next question becomes more important. What should you do with those profits when they arrive? Your action step. Look up one Canadian dividend company you recognize. Find its current dividend per share, dividend yield, and payment frequency. Then ask yourself, is this company paying dividends from real business profits? Or is the yield only high because the stock price has fallen? Here is where the story changes. Receiving a dividend is only step one. The bigger question is what you do with it. Most people think dividends are income. And, technically, they are. A company pays you cash. The money appears in your brokerage account. You can withdraw it. You can spend it. You can use it to pay bills. And for retirees, that may be the entire goal. But for young investors, especially Canadians in their 20s, 30s, and 40s, spending dividends too early can slow down wealth creation. Because every dividend you spend is a share you never buy. And every share you never buy is a future dividend you never receive. This is the part most people miss. A $100 dividend today does not look life-changing. A $500 dividend today does not look life-changing. Even a $1,000 dividend today may not look massive. But if those dividends are reinvested, they turn into more shares. Those shares create more future dividends, and those future dividends buy even more shares. That is the difference between using dividends as income and using dividends as inventory. The average investor says, "My dividend paid me $500. The wealthy dividend investor says, "My dividend bought me more ownership." Same payment, different mindset. That is why the early years of dividend investing can look unimpressive. You are not trying to create huge income immediately. You are trying to increase your share count. Because the income later is built from the ownership you accumulate today. Now we get to the mechanism that changes everything. DRIP stands for Dividend Reinvestment Plan. It means that instead of receiving your dividend as idle cash, your brokerage automatically uses that dividend to buy more shares. Let's make this simple. Imagine you own 100 shares of a company. Each share pays $1 per year in dividends. That means your portfolio receives $100 per year. Without DRIP, that $100 lands as cash. With DRIP, that $100 is used to buy more shares. If the stock price is $25, that $100 buys 4 additional shares. Now you own 104 shares instead of 100. The next year, the dividend is paid on 104 shares. Not 100. If the dividend is still $1 per share, you now receive $104. That buys more shares. Now maybe you own 108 shares, then 113, then 118. The exact numbers will depend on the stock price, dividend amount, and whether fractional shares are available. But the principle is always the same. Your dividends buy more shares. Those shares pay more dividends. Those dividends buy even more shares. This is why DRIP is so powerful. It removes emotion. It removes hesitation. It removes the need to time the market. It turns every dividend payment into an automatic buying decision. And when this happens for years, the portfolio begins to compound without you having to manually do anything. Your action step: check whether your brokerage offers DRIP or fractional dividend reinvestment. Some platforms automatically reinvest only when the dividend is enough to buy a full share. Others allow fractional shares. Know how your account actually works. Here is the part that makes dividend investing difficult. The early years feel slow. That is why so many people quit. A beginner investor might receive $20 in dividends, then $50, then $100, and they think, "What's the point? This is not enough money to change my life." But that is the wrong measurement. In the early years, the goal is not income replacement. The goal is ownership accumulation. You are not trying to live off the dividends yet. You are trying to use every dividend to buy more shares. Because the dividend snowball has 3 stages. Stage 1. Your contributions do most of the work. Stage 2. Your contributions and dividends work together. Stage 3. The portfolio begins producing enough income that the dividends themselves become a major growth engine. That third stage is where the results start to look unbelievable. But most people never reach it because they judge the strategy too early. This is the same reason compound interest is hard to appreciate. It does not grow in a straight line. It grows slowly, then faster, then suddenly. At first, the dividend snowball looks like nothing. Then one day, the snowball becomes big enough that every dividend payment buys meaningful new ownership. That is when the system starts feeling powerful. But the price of reaching that stage is patience. Now let's make this specifically Canadian. Dividend investing is useful in any account. But inside a TFSA, the math becomes much more powerful. In Canada, the TFSA allows investments to grow tax-free. That means if your Canadian dividend stock pays you a dividend inside your TFSA, that dividend is not taxed. If that dividend is reinvested through DRIP, the new shares are purchased inside the TFSA. If those new shares grow in value, that growth is tax-free. And if those new shares pay future dividends, those dividends are also tax-free. That means the compounding engine keeps running without annual tax drag. Outside a registered account, Canadian dividends from taxable Canadian corporations may qualify for the dividend tax credit. That can make them more tax-efficient than interest income. But tax-efficient is not the same as tax-free. Inside the TFSA, eligible dividends, capital gains, and reinvested growth can compound without annual tax erosion. This matters because taxes interrupt compounding. If a dividend is paid outside a TFSA, part of that income may eventually go to tax. That means less money available to reinvest. Less reinvestment means fewer shares. Fewer shares means less future income. But inside the TFSA, the full dividend can stay in the system. The entire payment can buy more ownership. And that is why TFSA plus DRIP is one of the cleanest compounding systems available to Canadian retail investors. The TFSA contribution room is limited, but once money is inside, the growth can become significantly larger than the original contribution. That is the part many people misunderstand. Your TFSA room controls how much you can contribute. It does not cap how large the investments inside can grow. Now here is the part every beginner dividend investor needs to hear. A high dividend yield does not automatically mean a good investment. This is one of the biggest traps in dividend investing. A 3% yield from a strong company can be much safer than a 12% yield from a weak company. Why? Because dividend yield rises when the stock price falls. That means sometimes a stock does not have a high yield because the business is amazing. It has a high yield because the market is worried. The stock price dropped. The yield looked bigger. And beginner investors see the high number and think, that's easy income. But if the business cannot support the dividend, the company may cut it. And when a dividend gets cut, two things can happen at once. Your income drops, and the stock price can fall too. That is how investors lose on both sides. This is why serious dividend investors do not only ask, what is the yield? They ask, is the dividend sustainable? They look at the payout ratio. They look at earnings. They look at cash flow. They look at debt. They look at whether the dividend has been growing or shrinking, because the goal is not just to receive a dividend today. The goal is to own a business that can keep paying and ideally keep increasing dividends for years. That is where dividend growth becomes powerful. A company paying a moderate dividend that grows every year can become more valuable than a company paying a huge dividend that eventually gets cut. The real goal is not maximum yield. The real goal is durable, growing income. Your action step. Before buying any dividend stock, check three things: dividend yield, payout ratio, and dividend history. If the yield is extremely high, treat it as a warning signal until the business proves the dividend is sustainable. So let's go back to the two investors from the beginning. Same stock, same starting investment, same dividend payments, same holding period. The difference was not intelligence, it was not timing, It was not luck. It was what each investor did with the dividends. Investor A treated dividends like spending money. Investor B treated dividends like future ownership. And over time, that future ownership created more income. Then, that income created more ownership. Then that ownership created even more income. That is why dividend investors can get rich twice. They get paid once when the company sends the dividend, and they get paid again when that dividend buys more shares that produce future dividends. But here is the honest answer nobody wants to hear. DRIP is boring. It does not feel exciting in year one. It does not make you rich overnight. It will not give you the same dopamine hit as chasing the hottest stock. But boring systems often build the most reliable wealth, because wealth is not usually created by one dramatic move. It is created by repeated ownership decisions made consistently over long periods. Dividends are not magic. DRIP is not magic. But a good business, held for a long time, inside the right account, with dividends reinvested consistently, that can become a powerful wealth-building machine. The real question is not whether one dividend payment changes your life. It will not. The real question is what happens when hundreds of dividend payments keep buying more ownership for decades. That is the power of dividends. That is the power of DRIP. And that is why dividend investors can get rich twice.